Okay, picture this. It's February 2026. The crypto market has just slammed into a brick wall. I mean, a brutal, rapid-fire sell-off that has sent shockwaves through the entire system, leaving every investor asking one simple question: what in the world just happened? Today, we're going to tear apart the anatomy of this crash. We're going to deconstruct it piece by piece and figure out exactly what brought Bitcoin to its knees.
First, let's just absorb the damage. From its recent peak back in October 2025, Bitcoin's price took a nosedive, plummeting a staggering 42%. And look, this wasn't some minor dip or a healthy little correction. This was a cliff, a violent, gut-wrenching move downward that basically erased months and months of gains in just a few weeks.
And to really put that percentage in perspective, here's the number that matters: $1.21 trillion. That's the total value that just evaporated from the crypto market's cap in only 139 days. It was an absolutely massive wipeout that hit every single corner of the digital asset space.
So that's the big question, right? What on earth triggered all of this? Was it just one single catastrophic event? Some kind of black swan that nobody saw coming? Or was it something way more complex? We're going to dig in and investigate the key factors that all lined up to create this perfect storm.
As it turns out, this wasn't just a single rogue wave. It was more like a perfect storm, right? A convergence of massive pressures hitting the market all at the same time. We've broken it down into three key pieces: a major geopolitical shock, a totally bizarre and costly internal screw-up, and, of course, the brutal, unforgiving mechanics of the market itself.
So the first domino to fall actually came from outside the crypto world entirely. A new 15% global import tariff, announced by the US, created this huge wave of economic uncertainty. And when that happens, investors get spooked. They start running from anything that looks like a high-risk asset. And yeah, Bitcoin was at the top of their list.
And the fallout was, well, it was immediate. On February 24th, the day the tariff was announced, markets just flipped into what we call risk-off mode. Investors fled from what they saw as speculative assets, and Bitcoin was right there in the crosshairs. But here's the crucial part, the part you really need to see. Bitcoin's price fell while gold's price rose. In that moment of crisis, the big money showed its hand. It still sees gold as the true safe haven asset.
So, as if that macro pressure wasn't nearly enough, something completely bizarre happened inside the crypto ecosystem. An incident at Bithumb, a major South Korean exchange that you can only really describe as, get ready for this, a $40 billion typo.
Let me walk you through how this unbelievable error actually went down. It all started with a simple little promotion. A staff member was supposed to send out small rewards in Korean won, right? But they accidentally set the payout currency to BTC. This one little mistake created about 620,000 ghost Bitcoin worth $40 billion and plopped them into user accounts. Now, these weren't real backed Bitcoins, just entries in a ledger, but the system let people trade them, causing this insane localized 17% flash crash on the exchange before they could slam on the brakes and freeze everything.
And this is really the key takeaway here. This wasn't some brilliant hacker finding a secret backdoor. No, this was an internal blunder, a complete and utter failure of the exchange's own safety nets. It exposed a shocking vulnerability that just shattered market confidence at the absolute worst possible time. So these external shocks then collided with the market's own internal machinery. Institutional demand slammed into reverse, with a massive $8.5 billion flowing out of Bitcoin ETFs. That selling pressure then triggered what's called a leverage flush. You know, when traders who borrowed money to bet on prices going up are suddenly forced to sell their positions to cover their losses. And that forced selling just dumps more Bitcoin onto the market, which pushes prices down even further, which triggers even more forced selling. It's a vicious, self-feeding downward spiral. So with all of this chaos swirling around, what was the mood on the ground? Well, this is where the story gets really, really fascinating, because it reveals this huge split in how different players were reading the exact same situation. On one side, you had the retail investors. The crypto fear and greed index just plunged to 8 out of 100. We're talking absolute, bottom of the barrel, extreme fear. People were panic selling, just capitulating. But on the other side, you had the institutional players, and they were buying the dip. On the very same day the tariff went live, spot ETFs saw a net inflow of $188 million.
See, for them, short-term panic is a long-term opportunity. It lets them scoop up assets at a discount while everyone else is running for the exits.
And this huge difference in behavior just begs a question. Who's right? The fearful retail crowd or the opportunistic institutions? So let's pivot and look to the future. Let's see what some of the models and the experts are forecasting for the price of Bitcoin from here.
Okay, so one technical analysis forecast, this one from Changely, actually suggests a pretty strong recovery through the rest of 2026. This model sees the average price climbing back over $80,000 by June, touching nearly $100,000 by September, and potentially ending the year over $120,000.
And it's not just them. The banking giant Standard Chartered, they revised their own forecast. And while, yeah, they did lower their prediction a bit, they still see a huge upside, setting a new and still very bullish end of 2026 price target of $150,000 per Bitcoin. For another way to look at this, we've got the rainbow chart. Now, this isn't for timing the market day to day. Think of it more like a long-term weather report. The chart's color bands show the market mood. And right now, after this crash, Bitcoin is sitting firmly in the blue buy zone. Historically, that signals a really strong value opportunity. It's a long, long way from the red maximum bubble territory that we've seen at previous cycle peaks.
And that historical context is so important. As one market observer put it, these scary months in a drawdown, they always feel like they're going to last forever when you're in them. But history has shown us time and time again that these cycles of fear are eventually followed by periods of recovery and growth. Patience is often the hardest, but most rewarded virtue in this market.
So we've seen a market that was brought to its knees by a perfect storm of macro fears, internal failures, and just brutal leveraged selling. But we've also seen this crystal clear split between retail panic and institutional accumulation, which leaves us with one final question to think about. In a market that's defined by these powerful cycles of emotion, is extreme fear a signal to run for the exit, or is it actually a signal to lean in and listen very, very closely?